The HUD 221d4 program can finance the ground-up construction or rehabilitation of apartment assets nationwide. Rehabilitation in this context would be anything over $45,000 to $50,000 a door being put into a building. So that could include a wholesale conversion, say from an office building to a residential building. It could be a completely vacant existing apartment building, or it could be a building that is up and running, operational, but it's tired and it needs that 45,000, 50,000 a door in improvements. So ground-up construction or rehab equaling generally anything over 45,000 to 50,000 a door in improvement costs. Borrowers can be for-profit or nonprofit. There's no requirement to include a nonprofit as a minority partner for any reason. The loan term is 40 years and it's fixed rate for 40 years. It's actually construction to permanent financing all in one, which I'll detail on a later slide. So 40-year fixed rate, fully amortizing. The loan to cost, the overall leverage of the program is 87% loan to cost for a market rate asset, up to 90% loan to cost for an affordable asset. There's another video on this channel that defines HUD's sort of definitions of affordable housing in this context. Debt coverage ratios are 115 for market rate assets, 111 for affordable assets. A key consideration of HUD is that you have to factor in prevailing wage into the construction budget, which generally does not have much of an impact. You don't have to hire union contractors, but the GC that you're hiring to build the asset or rehab the asset needs to incorporate applicable prevailing wages in the construction budget, which if you're in a major metro area or an area with a heavy union presence, that could have a material impact on the construction budget. I can assist you with those relevant prevailing wages based upon location upon request. You can leverage other sources of capital, but HUD will not allow you to do private secondary financing except in very rare low leverage situations. So like a seller holdback on the land or subordinate financing to help with equity, that's going to be a challenge to combine with HUD in a first position. Construction interest due during the construction period is capitalized in the mortgage, so that could be 14 months, 16, 18, 24 months, really varies depending upon the scope of work at a project. You don't have to have any sort of elderly restriction. The units can be marketed to what HUD considers family, so no age restriction whatsoever, or they can be elderly restricted, but elderly restricted under the confines of HUD would be 62 plus, not 55 plus, and typically HUD prefers head of household, which means as long as you have a person in a unit that's 62 plus, you could have individuals that are younger than that, and that improves the overall marketability of an asset. And these loans are non-recourse from day one. So they're non-recourse during construction, and when construction converts into the 40-year permanent term, it remains non-recourse. Common question we get is, do I really want to get locked into a 40-year fixed rate loan if rates are going to be dropping 5 years from now or 10 years from now? HUD has ways to modify the existing interest rate in a very cost-effective, streamlined fashion, which protects you kind of a long or short-term investment scenario. And I can, again, provide more information on these modification options on request. The loan program is available nationwide. There's no variance in leverage, which I think is critically important. So whether you're in a tertiary market or a major metro market, it's still 87, 90% loan to cost, 115, 111 debt coverage ratios. Generally, these programs should only be utilized for requests above $5, $6, $7 million. Reason being is all these great terms that you're seeing, there's sort of barriers to entry to qualify that in terms of developer experience, and also there's soft costs involved in terms of due diligence, like appraisal costs, market study costs. Because it's one closing for 40 years, there's more upfront due diligence, and the cost of that due diligence generally can be not as economical for smaller requests. Typically, in a smaller request, like 1, 2, 3 million, it might make more sense to go to a local bank or a credit union or an alternative lending source, finish the construction there, then come back to HUD for a permanent refi loan under the HUD 223F refinance program. We can recognize land value or building value in a rehab scenario as equity into the deal. There's a declining prepayment penalty, so there's no defeasance or yield maintenance. The typical declining prepay is 10.9876544321. The loans can be assumed, so in the event of a sale, if somebody does an assumption, you would not be subject to the prepay at that time. And you can have commercial space in a building, but less is more. HUD recognizes that you can generally lease commercial space for a higher rent per square foot than residential, which helps with the overall dynamics and economics of a development. However, they don't want to be very aggressive, assuming that rents are going to be coming in at X. They don't come in the commercial space, and you're essentially underwater from day one. So the total commercial space should be limited to no more than 15 to 20% of the building space in total building planned income. So as noted, though, kind of the one closing explained construction to perm all in one, you have a closing that occurs for construction, construction interest capitalized in the loan, the interest rate that you lock prior to construction starting carries through automatically, and at construction completion, a 40-year term commences with that same locked interest rate. So lock the interest rate before construction starts, mitigates all your volatility. Construction interest due during construction capitalized in the loan. When construction is complete, 40-year fixed rate term automatically commences at the same interest rate locked before construction starts, and it's all non-recourse from day one. In terms of eligible property types, sky is sort of the limit. You can do garden style, fourplexes, fiveplexes, elevator, non-elevator. You can have scattered sites. This is discouraged for new construction, but let's say in a rehab scenario, you have existing structures that are all in the same general market area, same general class, fit and finish. You could potentially combine those under one 221D4 sub-rehab loan. You could do renovations, including historic properties, row homes, high rises, low rises. Something that's important to know, which we see more and more of, is you cannot finance residential subdivisions with these programs. So at least 50% of the buildings on a site need to contain at least 4 to 5 units, which can include attached townhomes. So HUD does not like individual single-family rental type structures. You can't do dedicated student housing. You can rent to students, but you can't have configurations that are only targeted and marketed towards students. Condominiums, you can put a condo regime in place, but there's no ability to sell units piecemeal with a HUD loan in place. Mobile homes, drug rehab, medical, transitional housing, and the age restriction, as noted previously, you can't do 55 plus. It has to be 62 plus under HUD. In early 2025, HUD launched a new sort of partition, if you will, a new element to the HUD 221D4 program, where if you are targeting 50% of the units at rents that are less than 120% area median income, and I can assist you with that calculation if you're not sure how to calculate that. If more than 50% of the units are targeted at rents affordable at 120% area median income, HUD will allow us to slightly boost up the loan to cost and reduce the debt coverage ratio that we underwrite at on the lending side. So rather than it be 87% loan to cost and 115, now it's 90% and a 111 debt coverage ratio. This can be very powerful because sometimes 120% AMI may be kind of effectively natural rents in that market. You might be naturally affordable. So if you don't take any sort of haircut on revenue or collections, but you qualify for even higher leverage and underwriting, it helps with the overall economics of the deal. Required to be posted at closing, either through borrower cash or letter of credit, are some temporary escrows, so they are non-mortgageable. HUD requires you to set aside typically 2 to 4% of the loan amount and an initial operating deficit equivalent to 4 to 12 months of debt service. It varies based upon project specifics, but just know that HUD's going to require you, again, through borrower cash or letter of credit, they're non-mortgageable costs, to fund some escrows during the construction and lease-up period, which you can tap into, and if they're unused or partially used, they will be returned to you at project stabilization. So it's not designed to be punitive, it's really designed to protect all parties, to say, here's additional capital that you can tap into if needed, if lease-up's taking longer than anticipated, if there's some sort of requirement for construction contingency that occurs during the construction process, etc. HUD will allow you to use modular housing. It doesn't have to be traditional stick-built. However, modular housing has some considerations. HUD would need to review and approve the modular vendor. Generally, modular manufacturers require some sort of payment to get in the queue to have those units delivered in time for your requisite construction schedule. And HUD's not going to advance any monies prior to closing for that purpose. So that could be a situation where if a modular manufacturer is looking for a lump sum deposit, but you haven't closed on the loan yet, that can be at-risk capital that should be considered. And in general, HUD's going to be looking for architectural engineering services that are sort of commensurate and similar to a traditional stick-built development. So it's not enough to just say, I'm going to hire this new modular manufacturer. They're going to come and throw the units on the site, and that's going to be that. It's going to be treated like a kind of quote-unquote traditional construction transaction, even if the assembly of the units is occurring off-site and then being brought on-site. Common myth about HUD is that it requires affordable housing. You think of HUD, you think of Section 8 housing, low-income housing. A project does not have to have any affordability involved in it whatsoever. 100% luxury, 100% market rate. There's other common myth that the process is monumental pain. Undoubtedly, the HUD 221d4 program moves a bit slower than if you went to a local bank or a credit union, but part of the kind of timing of that is you're going through levels of approvals and intervals, including a kickoff call before any time or money is spent to start the process with us on the lending side and with HUD to make sure that there's no red flags from anybody's perspective. So realistically, for your first HUD 221d4 experience, you're probably looking at 9 to 10 months to get to closing. That could be shrunk down and truncated for projects that have tax credit involvement or for repeat HUD borrowers down to maybe 5, 6, 7 months. In terms of borrower experience, this is going to be non-negotiable for HUD. So I try to really highlight this. You need at least one principal on the ownership team who has prior comparable experience to the proposed development. So if you've only ever done fix and flip single family homes, now you want to come to HUD and develop a 400 unit apartment building, HUD's going to say, who on the ownership side, who on the development side has a track record of assets that are comparable in size and scope to what you are coming to us for now. We are not going to be your high leverage, non-recourse construction option for kind of first time borrowers dipping their toes into a larger scale type of asset. So prior comparable experience is critically important, and HUD's going to be looking for that experience across the board as well in terms of GC, architect, management company. Having more experience, particularly any prior HUD experience, is viewed extremely positive as it relates to overall approvals of the loan process. A couple kind of frequently asked questions that come up to end this video. So money that you spend on the underwriting process, like an appraisal, market study, those are all mortgageable costs. You pay them out of pocket prior to closing, but at closing, the cost would be credited on the settlement statement as a source of funds. So the money that you spend to get to closing doesn't just evaporate into thin air, it gets credited towards overall equity due. You don't need to have complete architectural plans. You don't need to have your permits and entitlements fully in place to get the process started. That can be worked on concurrently with that HUD underwriting process mentioned previously. You cannot receive a developer's fee if you are a for-profit borrower unless you have LIHTC involvement, low-income housing tax credits. HUD does not allow you to have any sort of line item in the budget as a mortgageable cost to cover construction oversight, monitoring, developer's fee, anything that's sort of a fee to cover your personal overhead or an incentive, for lack of a better term, for putting the deal together. That can't be included in the loan. If you're syndicating capital, you can have your partners pay that fee. We just can't pay it out of the mortgage. There's technically no credit requirements for principals in terms of like fixed minimum liquidity, net worth, FICO. It's more of a common sense gut approach. I use the Ferrari analogy all the time, where if you went to buy a Ferrari and you had bad credit, no money in the bank, and showed no income, it'd be highly unlikely that the Ferrari dealership would give you a car. If you're coming to HUD for a 20 or 10 or $30 million apartment building and you have poor credit, thinly capitalized, no money in the bank, I don't think you would qualify as a HUD borrower. So either individually or collectively with your partners, you need to show a financial strength that's commensurate with the size of the proposed transaction. You can do ground leases. I can send you those rules if interested in doing a ground lease. You do not have to have a piece of land or building under ownership. You could just put it under agreement, subject to further due diligence to minimize your out-of-pocket expenses and overall risk. Our company, but for lending, is the actual licensed lender under HUD. We only receive a payment at closing. You don't have to pay us up front, midway through. So that tends to work best for all parties. We're all mutually aligned and trying to get a deal closed. Offsite work is not mortgageable. So if you had to bring in a traffic light or some sort of work outside the boundaries of the site parcel that you own for the development, it would be considered a non-mortgageable cost under HUD. FF&E, furniture, fixtures, and equipment is mortgageable. However, it's not for furnishing units. It would be like common area, outdoor areas, patios, etc. You cannot do construction work on the land in advance. So HUD, they're monitoring the construction from beginning to end, monthly requisitions, etc. So HUD doesn't want you to go in and start putting in foundations or doing a bunch of heavy grading work, things like that, before their involvement. They really want to monitor everything, as mentioned, from beginning to end. And there are some benefits to developing an opportunity zone, but nothing that materially impacts the overall leverage of the loan. It's more some reduction in a HUD fee and some potential streamlined processing that HUD could offer. But overall, opportunity zone, the benefits are more realized from ownership on kind of the tax basis side, not so much with the overall underwriting criteria that we use on the lending side. So I hope that was helpful. Appreciate you watching. I know there's a lot of information here. Happy to dig into the specifics or provide more details upon request. Please reach out anytime, and thank you for watching.